And Roger, it's not the 75 basis points that the market's kind of eagerly anticipating and waiting to hear. It's what comes next, because there's this broad expectation that maybe after this 75 basis point rate hike, they will slow things down. What do you think's most likely?
Well, first, I think you're right to say that it's the what comes next that is the issue. Unfortunately, I don't think we'll get a clarity this week as to what they're planning because there's so much data that comes in. I think the odds of a slight step down to 50 are slightly greater than the odds of holding 75 one more time. But the other big question, Becky, is not just what comes next in terms of December, but how high do they ultimately go, and how long do they stay there? So there are a number of questions that have to be answered over the next couple of meetings.
Yeah, part of the reason that the market has done so well this month, at least in the last week or so, has been this idea that the Fed was going to slow down. And that's there largely because of the article that Nick Timiraos wrote from the Wall Street Journal, just talking about how maybe the pivot was near. But maybe people got a little carried away with that. In fact, yesterday, Nick Timiraos has a new article that's out that suggests that, look, the Fed could leave interest rates higher for longer, and they could go higher than people anticipate. It almost felt like a walking back of his earlier commentary.
Look, I think the challenge has been that the market, which is meant to be forward-looking, also has built in a kind of optimism, and I think it's disconnected from the Fed's deep commitment to getting inflation much closer to the 2% target. I think the market also has been, hanging on ideas, first peak inflation, then pivot, and losing track of the big picture, which is that inflation is dramatically higher than the Fed likes. Labor markets are still very tight. Survey data suggests that the CEOs plan to increase wages going forward for some period of time. And then the article that Nick just wrote suggesting that households are actually in pretty good shape when it comes to cash. All of these things, I think, will be driving the Fed to keep rates higher than maybe the market expects and for longer. And so I think that's been the disconnect. And frankly, it's to me, a bit of a head scratcher.
A bit of a head scratcher that the market's so optimistic and has taken off again?
Exactly, because I think they're overlooking the data that suggests that the underlying strength, which normally is a good thing and which we celebrate, is making the Fed's job harder. And I think they'll see in the December meeting when the Fed, issues its so-called dot plots, the SEP, that they will start to expect the terminal rate, the rate at which they slow down or stop, to be much higher than 4.6, maybe a 5 handle. And it wouldn't surprise me if, in reality, the Fed has to raise its rates to 5, maybe 5.25, in order to get inflation under control. And I think that possibility is not built into market psychology right now.
So you've been scratching your head, too, as you watch the month of October. Markets have been really on a tear, especially if you're looking at the Dow, up about 14.4% for the month so far. That came as a shock to you?
It was a surprise because, as I said, I think it's not a reflection of where interest rates are likely to go. Now, I would say that the earnings have been reasonably good for sure, but there have been pockets where it was not very strong and some surprises in some large companies that are very sensitive to the economy. So I think the market also is focused on, the strength that it sees in earnings and, only takes on board slightly some of the negative surprises. So overall, I was a little surprised at the strength of the market in October because I don't think it reflects what's likely to happen in interest rates going forward for the next maybe even year or so before the Fed actually starts to reduce rates.
Roger, if the Fed is data dependent at this point, what are the maybe 2 or 3 most important data points we're going to see over the next 6 weeks?
We have a couple of more inflation reports that are coming in over the next 6 weeks. There's several more reports on the labor market and labor market conditions of different types, including, obviously, the job market this Friday. And so I think that's the place to look. Is inflation really starting to cool? And I mean significantly, not just slightly. And are we seeing any let-up in the very tightness? The labor market is drum tight still, even though it's weakened a little bit.
So even if the CPI number cools by 0.1%, that's not enough because you need to see significant cooling?
It's certainly not enough. And I think we've heard Chair Powell talk about it. I think he used the word clear and convincing evidence. He's a lawyer by training. Those words carry a weight. And so I think the market is hanging on straws of hope that, oh, it's the Fed's job is done. I think the Fed is not going to react to, straws in the wind. I think they want to see very concrete evidence of a clear downward trajectory in inflation. A tenth of a point here or there is not the same as clear evidence of a downward trajectory on inflation.